Welcome back to Snowy's investing journey. Thanks for joining me. In episode 2 we covered off my second day of investing with Trading 212, moved over another £7,500 into the account and made some, frankly, random purchases across lots of different areas with no idea what I was doing. I'll just take a moment to remind you that nothing in this video should be considered as financial advice in any form, and that any investments made are at risk of both increasing and decreasing in value. So episode 3 is going to cover off day 3, 4 and 5 of the first week of my investing journey, and we'll be able to pick up the pace a little and cover specific mistakes in more detail. This time I'll quickly cover off the trades I made during the remainder of week 1, and then explain how I experienced the downsides of the Dividend Capture Strategy. Nothing significant happened in the world over these 3 days, however it is the run-up to Trump's inauguration and also the final few days of the Biden administration, so I suspect that plays a role as we get towards the end of the week. So part 1, the trades I did over these 3 days. I'm going to whiz through these as there aren't that many, so here it goes. Day 3 opened with the sale of the tech pie I invested in yesterday, the Vanguard FTSE 100 AC and BlackRock core shares, and I replaced them with £1,000 of Vanguard S&P 500 DIST. I also pumped another £1,700 into the US pie, as it was both doing quite well and had a few stocks with EX dividend dates coming up in the near future. The returns were doing so well in fact that I moved another £5,000 over from the cash ISA.
Stop it. Get some help.
And invested it all in the US dividends pie. I also sold the Jet2, Tesco and NatWest shares I'd bought on day 1 and 2 for a small profit. And lastly for day 3 I picked up another dividend stock with an upcoming EX dividend date, B&M. I bought £250 worth and expected a dividend of around £10 from that. As I said on day 2, I don't think the shares will lose value significantly, so this seems like an easy win. Day 4 started with a bit of a shock. I received notifications from a couple of tools I'd been using that the price of a stock called RLI had gone down around 50%. I was really worried about how much I'd invested in this company, but also that this just happened so quickly, overnight almost. Could it happen to the rest of my portfolio as well? I realised it was a stock split, but had to research what stock splits were, how it affected the value, etc., and checked my overall portfolio before I was content. In simple terms, a stock split is where a company divides its stock into multiple shares, effectively lowering the price of each share, with the aim of reaching a wider range of investors with lower prices. If a stock price currently has a value of £100, you own 1 share and the company initiates a 2-to-1 split, then the next day you'll have 2 shares, both valued at £50. Having got over my stock split worries, I decided that, as I was already over £15,000 into this, I might as well just throw the last £5,000 in as well. So I emptied my cash ISA into the stocks and shares ISA.
Stop it. Get some help.
Before anyone worries that I've put my entire life savings into this, don't worry, I haven't. I have alternate accounts, and if I lost all £20,000, I'd be financially okay. So during day 4, I purchased another £3,500 of the Vanguard S&P 500 DIST, and I bought £1,300 worth of the US dividend pie. The last trade I did is where the meat of this video is based. I sold my first dividend capture stock. I'm a residential REIT, but I'll come back to this in part 2. On day 5, I bought another £500 worth of Vanguard S&P 500 DIST, £300 worth of the US dividend pie, and £300 of the UK dividend pie. To finish off the first week of my investing journey, I sold the B&M shares I bought on day 3 for a small loss of 32p, not including the dividend I'd now earned. That brings week 1 to a close. Day 3 ended 0.08% up, Day 4 ended down 0.05%, and Day 5 ended a whopping 1.24% up. So at the end of the week, my portfolio was valued at £20,898. I'd invested £20,681 myself, so a profit of £217 at the end of my first week. For comparison, had I left all of the money in the cash ISA, I'd have earned just £13.50 in interest. But it's not all as good as it sounds. So part 2, the dividend capture strategy. I said I'd come back to a stock I sold on day 4, I'm a residential REIT. Well, on day 2, when I started looking at dividends and the EX dividend dates, all of which is mentioned in my episode 2 video, I didn't know that dividend capture was an actual investment strategy. What is the dividend capture strategy? Well, it's a timing-oriented investment strategy that focuses on buying a stock just before its EX dividend date and selling afterwards. The aim is to buy the stock, receive the dividend payment, and then sell the stock whilst making a profit overall. The share value may have decreased, but the dividend should cover that, and hopefully still leave some profit overall. This is exactly what I tried to do over days 2 and 3. However, I didn't know one key element. On EX dividend date, the stock price falls by roughly the amount of the dividend. When you think about it, this makes complete sense. A large chunk of cash or value is being removed from the company and given to the public or the shareholders, so the value of the stock should fall. The company doesn't have that cash anymore, so the company is worthless. This caught me out. As an example, I'd bought Buckle shares for $52.63 each, as they were paying a $2.85 dividend each. That's a 5.4% yield, which is huge. And I'd said to myself, as long as the share price doesn't drop by more than $2.85, I'll sell the shares the day of EX dividend or the day after and reap the dividend in a couple of weeks' time. It might take a couple of weeks, but overall I'll be in profit, even if the share price does drop, as long as it's not by more than $2.85. Well, guess what? On the EX dividend date for each of the 6 stocks I bought, the share price dropped. For some of them, it dropped a lot, and more than the value of the dividend. Buckle caught me out, but it wasn't the only one. RWS Holdings and Premier Mitten also dropped significantly. Another element I didn't factor in was the US withholding tax. Even though I'm doing all of this in an ISA, which is tax protected, non-US citizens still incur a 15% tax on US dividends, regardless of what account I use. This meant that the $2.85 dividend from Buckle was actually going to be a payment of around $2.42 per share. Finally, the last element that kind of snuck up on me was the currency. Whilst I knew there were different currencies and there'd be an exchange rate, I was caught out by the way Trading 212 works. Trading 212 shows me all of my financials in pound sterling. Using Buckle as an example, I was hoping for a share price drop of less than £2.42 per share, because Trading 212 shows me my values or returns in pound sterling. Really, I should be looking for a drop of less than £1.96, as that's what the dividend is likely to be after currency conversion, the currency conversion fee, and the US withholding tax.
Stupid!
No, we're gonna we'll dry you off.
So in total, I invested in 6 different stocks for dividend capture. 3 of them, B&M, Armour Residential REITs, and Fairfax Financial Holdings, all returned a profit with the dividend included. The share price of the other 3 stocks, Buckle, RWS and Premier Mitten, all dropped far more than the value of the dividends, so I didn't sell and I've kept hold. My overall outcome with dividend capture? Well, with 2 sold and 4 held, I'm currently in the red for those 6 investments, and it's very red. I don't have a firm strategy for identifying stocks that either won't drop too significantly on or around EX dividend date, and based on how RWS and Buckle currently sit with me, it feels like a really big gamble. So for the time being, I'm staying away from the dividend capture strategy. Maybe I'll take another look in the future, maybe I'll focus on UK stocks as there's no currency fee or 15% US withholding tax, however there is stamp duty instead. Maybe I'll try and identify stocks that have a history of not dropping significantly following EX dividend dates, but that seems like far more work than I was hoping for with this journey. So we finished week 1 with a whopping £217 of profit, around a 1.05% return on investment, despite heavy, unrealised losses with the dividend capture strategy. I was really happy with this. Imagine if all 52 weeks this year are like that. My 20 grand will be 30 grand in no time. And at this point, no dividends have been paid either. So moving into next week, I'm going to start looking at better ways to dividend invest. I'm going to look into other ways of investing and look into other financial bonuses I can get in the UK. It's Trump's inauguration on Monday, and I am slightly worried about volatility and uncertainty in the market with the transition of power. But I'm up over £200 in my first week, so starting this journey now feels like a fantastic decision, so I'm sure it'll be fine, right? As always, thanks for sticking around to the end of this video. I hope it was a good laugh for those of you that know what you're doing, and if you're new to this, like me, I hope you spotted my errors and mistakes and not making them too. Please leave a comment, leave a like and subscribe. It really helps me with the YouTube algorithm, and I look forward to you joining me again next time. Thanks.